There are a number of factors a lender takes when considering whether to loan out money, but let's talk about two in particular, which are each having noticeable impacts on commercial real estate values. Let's start with the most common one, loan to value, or simply the ratio of the amount of the loan divided by the value of the property. Most lenders will have a provision that this amount will be the lower of the sale price or the appraised value, and it'll typically be in the 65 to 70% vicinity for most commercial loans. But there's another metric that's gaining a lot more attention over the past year called the debt service coverage ratio, or the debt coverage ratio. It's a fairly straightforward calculation as well. The DSCR equals the net operating income divided by the annual debt service. We can walk through an example to show how interest rates are putting a considerable amount of downward pressure on how much buyers can afford. There are also some profound implications for existing property owners, which I'll get into right after. So let's jump over to Excel and I'll walk you through an example and these spreadsheets that I have, which you're free to download and you can change and adjust to however you feel fit. I have a link in the description, but if you just head over to industrialize.com, there's a tab for free tools. You can get this spreadsheet. And I think that this is very powerful for showing people how much the interest rates have actually affected the amount a borrower can borrow. So in this one example, let's just say 2021 interest rates will be the first example. And we're going to set an arbitrary $250,000 for the net operating income. And we'll say the lender has a 1.25 debt service coverage ratio. So if you divide the two, that gives an annual debt service of $200,000. Now we can take that $200,000, divide it by 12, and that will give us the monthly payment. In this case, I'm going to assume that we could get it for 3.5%. Back in 2021, might have been a little bit higher, might have been a little bit lower, but just for this example, I put in 3.5%, and I did a 20-year amortization. So this formula, the present value formula, will tell us the maximum amount that they could get for a mortgage under this scenario with $250,000 in NOI and the 1.25 debt service coverage ratio and the 3.5% interest. That's the maximum amount that they can get for a loan. Now, if the buyer wants to have that loan to value ratio of, let's say, 65%, then the maximum that they can pay for that property is $4.4 million and change. So that doesn't necessarily mean that that's what the value of the property is, but that's the most that this buyer could pay in order to meet the debt service coverage ratio and the loan to value ratio. And that so happens to correspond to a 5.65% cap rate. Now let's go over to today's interest rates, and we're going to keep everything the same except change the interest rate. So same NOI, same annual debt service, but in this case, I'm going to change the interest rate to 7.5%. And again, this could be higher or lower. When you download the sheet, you can change this to however you want. I just put in 7.5%, but you can see now that the mortgage that that person can afford is just over $2 million. And if we use the same loan to value ratio, that means the most that this buyer could pay, again, to meet those restrictions that they have in place, is $3.18 million. So it's a significant drop in how much the buyer can afford to pay if they want to get financing to meet that loan to value ratio. And that works out to a cap rate of 7.85%. So this has really had a profound impact on the amount that buyers can finance. And unless it's somebody that's putting a large cash position down, maybe they're putting 50% down, the properties aren't financeable in the current form that the way that they were as short as a year and a half, 2 years ago. So I think it's a really powerful tool if somebody is still thinking that they can get cap rates from 2 years ago. It might be possible if there's a buyer out there that's willing to pay it. But if they want to finance this property, the numbers have changed just as a result of interest rates. And I used this data on the next tab here to create a chart, which shows essentially the cap rate needed in order to meet the DSCR requirements. So on the top row here, that's the loan to value ratio. On the column here, this is your interest rate, and you can change the DCR, you can change the amortization if you like. And what it will do is it will actually tell you what cap rate is needed in order to offset any increase in interest rates. So it's a very valuable tool. If you just want to see if a property, so let's say 65%, if the mortgage, if the interest rate at 4% resulted in a 5.9% cap rate and it goes to 7%, well, that cap rate has now gone from 5.9% to 7.6%. So it really has had a dramatic impact. And I think that this tool is helpful just to show people that, yes, interest rates have had a major impact, not just on cap rates, but the amount that buyers can afford to pay and justify for these properties. So again, free spreadsheet, put a link in the description. I created this originally in Excel, but I'll also include a link to Google Sheets if that's more helpful. But I really do think that this is a great tool in the arsenal if you're a broker or an owner, just to see the impact that interest rates have had on values. Now, coincidentally, there was a recent report which suggests cap rates have increased roughly 100 basis points as a result of higher interest rates. If we go from a 6% cap rate to a 7.5% cap rate, this drops the value to nearly the same amount as the DSCR calculation. Naturally, we could massage these numbers in any direction, and each market and individual property will vary, but this type of exercise clearly illustrates how prices have been impacted. Now let's address how this affects existing owners. Since lenders have DSCR requirements for loans, this naturally applies to existing mortgages as well. So owners who have mortgages coming up for renewal might be in a position where current interest rates mean their DSCR falls below the lender's requirements. And considering there's over $1.5 trillion worth of mortgages maturing over the next 3 years, this should be on everyone's radar. It depends on how the loan was originally structured, but the borrower likely has to maintain this ratio, meaning one of two things need to happen. First, the net operating income can be increased. However, this might not be possible for scenarios where there are term leases in place or just that the market cannot simply support increases. Second, the owner will need to inject cash into the deal in order to lower the debt. You've likely heard the term cash-in refinance lately, and I'd anticipate it will become even more common in the months ahead. Now, not all is doom and doom, of course, but it does underscore that we will have a challenging year ahead. And on that note, I'm setting up a membership-based community where investors, brokers, and other professionals can network and learn from each other. There'll also be opportunities to ask podcast guests questions and get access to exclusive industrial real estate content. Just head over to industrialize.com and click on the membership tab to learn more. And if you got any value from this video, I'd greatly appreciate it if you hit the thumbs up button, or if you didn't like it, hit the thumbs down button. I like feedback of any kind, so leave me a comment, good or bad, in the comments as well. And thanks for watching. Catch you in the next video. Owners, why am I struggling to say that? Or hit the thumbs down.